Welcome to MarketTamer.com. Today we'll take a quick look at the options chain and explain a few features and patterns that might be useful when you're trading stocks and options. So this chain here is coming in from Options Express, courtesy of Options Express platform. And we'll just note a couple of things. Really, the points we'll highlight are going to be very applicable to any stock you look at. But in this case, we'll just look at Baidu. We can see it's trading at $235 per share, thereabouts. What's really interesting here is take a look at this strike 240 option here. So if we come across here, we can see a bid price of 710 on this call option. And what we could do if we wanted to generate some premium, if we own the stock, is simply sell this option against our stock holding. For example, if we had 100 shares, we would sell one contract. If we had 1,000 shares, we might wish to sell 10 contracts. And if we did so, let's just keep it simple and say we owned 100 shares and we wanted to sell one contract, then we would bring in $710 here for this option. Now if you're looking at the price here and saying, wow, 100 shares times $235 is a lot of money, don't worry about the price. Just think about the principle here. The principle is simply owning stock and selling options, and so this can obviously be done on much cheaper stocks also. But the point I want to highlight today is note this $7.10. It's available to us if we sell this strike 240 option, and we can capture that 710 over the course of 14 days here. There are 14 days through to May expiration. What's really interesting is if we go out 1 month out to June here, which is an extra 30 days or so, we see with 49 days to expiration, we see that the strike 240 option is bringing in $15.50. So this actually causes a lot of confusion to traders who are beginning. Why is it that over 14 days we capture just $7 and over 49 days we capture just twice that? Shouldn't we capture much more than that, given that we're looking at a much longer time frame to expiration? And in truth and in practice, we find that the way that the options are priced is such that if we go out further in time, we don't see a linear relationship between the value of these options and the time remaining through to expiration. For example, if we go out to September, we might intuitively think, well, if there are 49 days to expiration and we capture $15.50, then if we go out, almost 3 times as far, 140 days to expiration, we'd see 3 times the premium. And we do not see that 3-time premium. We only see $31, which is about twice as much. So in practice, we have to pay attention to the fact that over short time frames, we can actually capture a lot of premium if we short options month in, month out. Now, there are trade-offs to this. Obviously, if we short options in short time frames, we don't bring in quite as much money like in June or in September. However, it's a very profitable and lucrative strategy, especially when stocks start to plateau and not trend aggressively in one direction or another. And the final point to note is that here, if we did sell this option at strike 240, we could benefit from the stock movement all the way up to 240. Above 240, we know that this option means we have an obligation to sell stock. If that occurs, we capture the 710, sell the stock at 240, so we'd make money on the stock and on the option, and ultimately have a real winning trade. There's much more to this strategy, and obviously we cover all the implications at MarketTamer.com, so feel free to come over there, chat with a great group of guys, and we'll be happy to help you out.